I find at conferences like this that very often, if there is a criticism, it's about this. At family office conferences, you're looking, as you organise your business, 30 years hence for some kind of retirement fund, or 15 years hence for a college fund. And too often the advice that we get at these conferences is for the next 12 months ahead. Well, I've said that to our gentlemen here. They've all been very cooperative and said that they're trying to give them more medium-term solutions, even though it's a damn difficult thing to do. I know that's particularly going to be in the bonnet of Mark Hendricks. Mark, you are Chief Investment Officer for Sandair. You also were a Senior Economist with SocGen, where you would have done crystal ball gazing, but be honest, how easy is it to make some kind of long-term judgments about things? Give that perspective.
Well, thank you for that nice question. But obviously it's very difficult, because otherwise we will be doing it. So let me just say what we're actually doing. Sure. That might be helpful. Just to put it in context, though, we're looking after families and endowments with very long time horizons for investments, but nevertheless worry about the valuations every day, and also require liquidity. So obviously that puts constraints on the portfolios, and we also manage a number of OICs which have certain regulatory requirements. So within that framework, we do two things. Firstly is to try and maximise the returns over the short term. I'm not afraid to say that. The short term not being every day, but over a 6 to 12 month time frame. Because my view is if you can maximise those returns with a sensible risk profile, then you're going to do okay in the long term by definition. And then we also try and identify long-term themes. So to be very quick and say what that actually means, we are clearly in a disinflation environment, and we have got lots of liquidity, as we've just heard from Sir Howard Davis. And my economics teaching tells me that that will be very good for asset markets, and whether it's good for the real economy, I simply have no idea. But I don't need to worry about that in my job. So we are very fully weighted into public equities. We can talk about that in detail. But we're also seeking to get long-term capital growth, because clearly those strong returns in public equity markets are not going to be with us over the next 5 to 10 years as interest rates start to rise. So we're seeking to increase our portfolio in unlisted direct investments in life sciences and technology.
Okay. Well, we'll divide this up a little bit more now. We'll look at high returns first, maybe long-term stable growth in a moment. You've given us some ideas already there. Tell me where you're looking especially for high returns. Put a bit more detail on that.
Right, okay, well, thank you. So in the short term, I fear we are with the consensus. We are very overweight public equities, and that is concentrated into Europe, Japan and China. And the Japan and China are basically tracker trades, because managers aren't doing very good performance for us there. And in Europe, it's again tracker, Eurostock 50, a growth tracker, and a basket of 15 EU banks, which should be the prime beneficiary of QE. Then elsewhere, we have active managers in the United States focusing on growth sectors and mid-cap companies. I think that's would that be a positive return, hopefully, over the medium term. And I think that's a strategy that will stay with us for some time. We have virtually no fixed income whatsoever, although we recognise there probably is value in some of the credit space.
Okay. Peter, as CIO for the Miro family office, you're looking at the energy sector. Shorting were long on energy networks, I think. Where for high returns?
For high returns, well, the big chunks of the money are in property and credits. So on the property side, there is some opportunistic trading. On the credit side, my principals, who takes care of the credit, focuses on accepting higher or lower credit worthiness for yield, although I think lately the duration is shrinking of the portfolio and the leverage. And on the equity side that we look after, we outsource investments in activist approaches, and what we directly do is we are invested in merger situations in communication being alternative telecom content producers. We have some investment based on a cyclical recovery in construction, and we have some investments in energy, arguing that companies that have a very large backlog may be able to outlive the current decline in energy prices, and hence the valuations of these companies are perhaps.
Well, I know somebody who agrees with you on that. I think it's Giles. Giles, your CIO of Rampart Capital. Yeah, you see, first of all, mergers and acquisitions, a big scope for activism in equities as well.
I think that's true. Just to go back to the crystal ball gazing, I guess our approach is to look to buy things that don't require good news in order to make returns. And so you're prioritising around the reward that you're getting for the risk that you're taking on. So if you then have a unexpectedly benign tailwind from central banks or growth rates or anything else, then that's on top of something that made sense anyway. I think in terms of the time frame as to what is short term, medium term or long term, if you've got 10 people in a room, you probably get 11 different views. One of our clients I was talking to last week, and he described his approach, his time frame as being 10 years, but a month at a time.
Okay.
Which, to some extent, you have to straddle. So in terms of where we see the most attractive returns from the year ahead and from the next sort of 12 to 36 months as we look at it, I think there has to be, if you're looking at the major influences, European QE is big, and whilst it's not going to have the impact on yields that the US version had, because they're a lot lower to start with, it is likely to have a significant displacement effect by pushing people outside the markets where it is active. And so we're positioned around that in assets which we think are attractive anyway, but where there should be additional liquidity and additional flows. Property, certain areas of the property market are very interesting, and specifically where there are angles around the structure of investors or the structure of banks that lead to higher returns than one thinks that you deserve. That's an area where we're interested. The whole credit market is changing, and we're involved a little bit, but I think we'll be a lot more involved in the banking disintermediation story around peer-to-peer lending and moves into invoice discounting and factoring and so on, where effectively you have a business model which is building a better mousetrap, so you're just getting a bigger premium for the risk that you're running. Lastly, I think, and probably most controversially, we are positive over the long term, i.e. a sort of 5-year view on certain oil assets, exploration and production assets, where we think the next sort of 12 to 18 months is a time where you can buy very high quality assets very cheaply, and the market won't always be like it is.
Give me that time scale again over the next...
Over the next in terms of the acquisition, over the next 12 to 18 months. But with a look to the market to normalise over the course of the next 3 to 5 years or slightly beyond.
I think I remember I asked delegates in the hall to see if they've got any clever ideas for high returns and suggestions and comments from you on those. Let's look at emerging markets. Okay, a lot of growth rates not as mouth-watering as they used to be, but still hefty there. Any of you specifically looking at asset classes in those emerging markets?
Well, we have some investments in China, both listed and unlisted, so direct investments. Is focused in the normal sort of healthcare, domestic consumption themes, and also just the A shares, pure and simple, because of what's going on in the liquidity growth combination. You don't want to have just strong liquidity. You want actually weakening economic growth to get the really powerful effect on equity prices, which is so you have that combination at the moment. Elsewhere in emerging markets, actually, it's really wholly Asia. So we have some small mid-cap exposure in Asian markets, And we have some property exposure there because we're very excited about the long-term property dynamics there. But in other emerging markets, I'm afraid to say in Latin America we have absolutely nothing, and in North Africa absolutely zero. Eastern Europe we don't have anything like that.
Does that sound familiar, Peter?
Yes, it does. So property in North Japan, Asia, and governance is increasingly an issue, especially for the area I look at, which is listed infrastructure. You need policy to be supported, otherwise you can burn your fingers by investing in long-term fixed projects. You can't take a motorway and put it into your handbag and run away with it if the regulators change their mind. On the other hand, I actually think home is good.
Let's have a little look out there and see, by a show of hands actually, is everybody pretty much convinced they can produce high returns? Put your hands up if you're still convinced there are some things out there that are sufficiently attractive and you would describe them as high returns. Put your hands up if you're fairly confident about finding things that are useful. Could we have any ideas about this lady here, for example? If you could have a little microphone that we can get over to this lady here. Good, man. Thanks so much. Tell us your name and title if you want to. Tell us what you're going to do. Take your time.
Hi.
It sounds like it's a really good investment, so you're very excited about it.
Actually, about high return, my view is you can get high return pretty much in any country, in any industry. You invest in a project, you invest in a team. So it's kind of where your expertise lies, how well you are familiar about trends in certain industry across the globe. So for example, I cover Ukraine. Everyone says it's crazy. I left Morgan Stanley to start business on Ukraine. They said to me, what's wrong with Morgan Stanley? Kind of. But I know the market. I know market inside out. And people view Ukraine very differently to me. It's an example. If we talk about industry, I am very bullish on IT. For example, you can make a lot of money in IT. Like Ukraine very strong in IT, UK very strong in IT, New York, USA, so kind of growth, high return is there. It's all about picking a right opportunity with the right team.
At the very start, I was going to say you require a lot of due diligence if you're going to go into this and things like that. You've got it innately.
Everyone requires a lot of due diligence.
Okay, that makes sense. Anybody else want to give us some ideas and get some reactions from it's here? Gentleman over there. Cool.
Thank you. My name is Roberto Miton from Margaret Advisors. We are investment advisors in food and agriculture assets. And I think that in the next 12 to 18 months, you can also get good returns by investing in South America into different themes that have to do with animal protein, in some cases some agriculture assets as well. I think that the fact that the commodity downturn has affected many of these countries, and you have seen also some depreciation and also a maturity in the initial wave of investments into food and agriculture that happened in the last 5 to 10 years. It's opening a window of opportunity for investors that recognize the long-term potential of the region.
Agricultural commodities especially, and they're not so much interfered with by government regulation. For example, we see interference in the oil industry. Genevieve, would you give that, take the mic back to that gentleman? I just wanted to clarify. You're thinking that agricultural commodities especially aren't being interfered with by government so much?
Yeah, I think that you have to see each country individually because you have different realities. Brazil, Argentina, Uruguay, Paraguay, Chile, Colombia, Peru. I mean, we can see different things in these different countries. I think that you have issues with regulatory aspects in terms of land ownership, and also in certain cases with tax regulations for commodities. I would actually avoid the commodity business. What I'm focused really is on real assets that are tied to the production of food with export products.
That's the lady from Ukraine. I'd like to go back to this again. Again, it's about due diligence, isn't it? You sound as though you've got some expertise in that area. It's not something that everybody can duplicate, but there you go. Go ahead.
Hi, it's actually, I mentioned about IT and about strengths of Ukraine in IT. Gentleman mentioned about agro sector. It's second or maybe at the moment first Ukrainian strong point. Like 1/3 of the most fertile land is in Ukraine, and talking about buying very cheaply, very high quality assets. In Ukraine, obviously, you cannot buy land, agro land, but you can lease it. But at the moment, there are a lot of talks about buying land. So it's an example. It's in no way invitation to come to Ukraine and buy a land. But as an example, I think it's, if you can buy, if a law is passed in the current climate that agro land in Ukraine can be bought, I think Ukraine will be flooded and for right reasons.
Well, you're right about it. If you can buy the land, because I've talked to British farmers who've made a fortune going over there, bringing their kind of large-scale production kind of techniques over there. But the problem is they've got to get an awful lot of people to agree before they can buy the land, so they're leasing and so on. But maybe we'll have a little another chat from this gentleman here. Oh, that gentleman over there.
Yes, hi Tim. I think the first question is, what is a good return? I don't know.
3%.
The lady here is from Ukraine, the guy from South America. But everyone is talking about like businesses in their home country. Whatever. I'm coming from the Middle East. I don't have anything I think to say in this region. But to be honest with you, I will go with Mr. Mark about saying about going to private equities rather than public equities in the long term.
And I think I might bring it back to the speech actually and say, at the start of this, I wouldn't have even expected people really to be looking at South America, and I certainly wouldn't have thought about people talking about the opportunities in Ukraine, although wherever there's a crisis, there's of course a margin and so on. But this tells us what we need to know, isn't it? It is about, there are opportunities out there, but you need the expertise, you need the due diligence. Peter?
Without any doubt. I mean, the more an industry is domestic, the more local insight that has to have, and without any doubt. I mean, if you have an in-depth knowledge in one area, then for us that sort of operates on a wider scale, we need to outsource it.
Peter? Mark?
So obviously due diligence is important, and we work for family offices and resources are limited. So the question is, how do we do that? So I said that we particularly like technology and life sciences, and particularly like venture capital startups at universities, and we invested in listed companies that specialise in intellectual property, which are here in the UK, which we have a certain specialism in. So the way but we also have investments elsewhere in direct and private equity, and we do that by having a network of trusted network, and I think we probably all say that. But that is critically important, because I'm hugely optimistic about the long-term economic outlook, hugely optimistic. There are things going on that, never mind the fiscal monetary issues that are going on from a corporate perspective and the technology and life sciences development. We have got an accelerated pace of change that we have never seen before. So I think we need to tap into that, and the only way you can do that is by trusting other people, and that's not about financing fee agreements, but having an alignment of interests. So we have formed associations. We have the Wigmore Association as one, which is 7 multi-family offices around the world that helps us do that. And we also have people that private equity funds, companies that are specialising in that, and we keep that to a handful of people that we can have close associations. We won't cover everything. We can't cover Ukraine, we can't do all of Latin America. But if we stick to the big themes, because it's always a relative choice, I think you can make substantial returns. I agree with the lady. This is the time when you can make substantial returns. But they're not just going to be through the public equity markets.
Charles, what about that observation from the gentleman from the Middle East back there? What is a good return?
I don't think you can answer that without talking about the risk side. I mean, that's a sort of terribly lame response, but if you look at the Ukraine, absolutely, I'm sure you can generate enormous numbers from specific positions, but before you go into that, you have to look at what the risk is, what the downside risk, and political risk, the risks of the legal integrity of the country are very hard to get comfortable with. So you end up making an allocation which you're prepared to lose when you put it in, which means it's very small, which means you need a big number to get you back where you would have been if you'd done something that was less colourful in the first place. So it can be a sort of nil-sum game. I think that the things that occur to me are clients and families generally are very good at making operating businesses out of opportunities, and I think that in the family office space, the opportunity to do that and not have a purely financial response, not to have a sort of investment bankers or investment analysis approach, but to actually say, well, the opportunity set here is to build a operating company, and whether that's in public markets or private markets is a secondary question, but we can form a business here, we can take an aggressive strategy if that's what we want to do, and we will get the right management team in there, and we will sit as the glue in that project. And I think that's a real strength that family offices, particularly family offices and multi-family offices, have in terms of maximising the returns that they generate from the risk they run. The second thing is that the multi-family office and the family office space has a very different approach to competitors / peers within that arena, and there is a very much more federal, open-minded approach to partnering up on things where it makes sense to, and realising that none of us can or wants to rule the world, and that we're just very happy sort of being good at our bit of it. And that's something where if you are a conglomerate and you do everything, it's very hard to find anybody who wants to partner with you at all. Whereas if you're a small organisation and the relationships are driving the external partnerships, then it works much better.
Speaks to that intimacy again, doesn't it? Let's get a couple more ideas about high returns.
Hello, I'm Gareth Watkins in Wellington Management, and just want to pick up on some of the trends that Mark was alluding to. Specifically, we're encouraging clients to look at the healthcare sector because we think there are a number of drivers there, longevity in terms of us all living longer, demographics, more older people around, plus growing wealth in the emerging markets, which as you get richer, you dedicate a little bit more of your income to your well-being. They're powerful factors in and of themselves, but what I think people don't necessarily grasp at this point is that we're on the cusp of a revolution in terms of therapies in the cancer spectrum, for example, which are going to transform the way people have been treated, and it's going to be very cost-effective for government. So there's a huge amount going on in that sector and in the biotech sector, and we think it's a very interesting area for clients to look at.
Now, Gavin, I think you're cheating a bit because I think you're going to be telling us about that later on.
I think that's a hard
I'm glad you cheated. Another item, that was good. Anyone else with just a little, yeah, go ahead, just
good morning.
Oh,
Hi, I'm Anthony Schatz from the law firm RPC. When we speak to other financial institutions like insurance companies, sovereign wealth funds, and so on and so forth, they often point towards allocation towards alternatives, which I think of as private equity, real estate, hedge, debt and infrastructure. For a long time, I think the sort of asset allocation for those big institutions was at 5%, and often now we have discussions where it appears as if that's moved to 10% or even higher. And I'm interested to know from the panel, in terms of trying to target higher returns, what your thinking is in terms of asset allocation towards those alternative assets.
It's a very complicated question to answer, so I'll try and. My views on asset allocation are not widely held, I guess. I have problems with how you define different asset classes, since I can show you examples of bonds that behave like equities and equities that behave like bonds and so on and so forth. More fundamentally, it takes you into a kind of benchmark-driven world where if you're using the last 30 years of data, you think that bonds are great and have very low risk, but the one thing you're not going to have over the next 30 years is a repeat of that because curve won't do it. So, and then the more you drill down, if you look at one of the things that credit ratings don't take into account is price. So if you've got a bond which is defaulted that's got a recovery rate that's double the current price, that's a much greater risk than a bond that's trading at 130, which is going to be redeemed at part. This isn't the way that we look at the world, because it doesn't have a very common sense orientated approach to risk. We just start from the basis of what risks can we see, what returns do we generate from those risks, and effectively we build a portfolio which represents a number of specific risks which we're happy are not going to exhibit any unexpected commonalities or correlations over time. And when you're right, you make a good return, and when you're wrong, you don't lose very much, and that just generates a very consistent thing. So it's moving away from a kind of overall historic data model-driven approach and into a more pragmatic and I guess a sort of more a decision-making process like the families that we manage money for had in their operating businesses.
I think I'm going to move on now from making high returns to making stable returns, where that is in conflict. And Mark, when I asked you where you were looking for stable returns the other day, you just laughed at me.
Yes. So, I mean, almost as a follow-on from Giles' very sensible remarks, really. This is not an income environment, so if it's not an income environment and you've discovered income, you know there's going to be a risk. So we know about disintermediation of the banks and the direct lending funds, of which there's a huge proliferation, and I think that is attractive, and if you're forced to go that way, then those are things you need to look at. I'm in the fortunate position that even though we have tens of clients, none of them actually require income. So my mantra has been, this is not an income generating environment, this is a capital appreciation environment. I don't see that changing, so let's focus on that in whatever form that is. When it becomes an income generating environment, we will tilt the portfolio towards income generating assets. I don't like infrastructure because it's just too big for me. We like to be involved in investments where we have touch and feel and relationships, and I'm not saying it's a bad asset class. It just doesn't suit what our clients want.
Now that's interesting, because Peter, you are interested in infrastructure stocks, aren't you, long term?
Yes, I mean it's on let's say on the equity side, there's a colleague of mine that looks at equities from a quantitative aspect. I look at more fundamental. On the fundamental side, we both try to serve the objectives and the mandate we have from the family we serve, which is largely capital preservation and income. And within the listed infrastructure companies, we are able to build a portfolio which have dividend yields around 5%. And we try to distinguish ourselves from an ETF, for instance, by having a perhaps more complex investment process that uses some shorting and some hedge overlays in order to also serve the capital preservation side. And let's say, to answer you on the infrastructure side, policy, being it energy supply security or competitiveness in communication or ecological objectives, give the regulatory support but also some growth prospects. And if you apply that to listed companies, the customer, our clients, also have a level of liquidity, so they can get out of their investment if so is required easier than they would from private equity.
Could we talk about ETFs? We're going to talk about ETFs shortly. Giles, Mark mentioned a particular sort of style of lending. You think there are some smart ideas out there, like, for example, investing in peer-to-peer lending. Give us some ideas that you've got for stable returns. How can that be stable, actually? How can you create certainty of that?
I think that the point on peer-to-peer lending specifically is just that the underlying risks are broadly the same as they have been historically in terms of lending to using same lending criteria to a diversified pool of people. It's just that you're being paid more for it than the banking industry is, which means that it's attractive relative to that. I think, I completely agree that it's not an income generating environment, and to some extent, insofar as you're trying to do that, you're trying to bend reality to fit your needs. Our solution to that has been partly to peer-to-peer lending and bits and pieces like that, but also to do bilateral loans on property and assets like that, where the downside we feel really comfortable with and where the returns generated are more than we deserve. they're not liquid, and that is an issue for some people. I guess it's an issue for the mainstream, but on the other hand, issues for the mainstream are opportunities for those of us that don't have to sit in the middle of the keyboard. So I think that's been a way for us to synthesize it. As a separate point, I don't think that you generate low volatility, steady returns by filling a portfolio full of investments that are low volatility with steady returns, because you end up with effectively a lot of things that behave very similarly, and they will all exhibit a lot of interest rate risk, which I think there's a reasonable chance will kill you over some shorter period of time at some point over the next few years. So it's steady returns arise from the relationship between different holdings within the portfolio. Old-fashioned diversification, but I don't mean diversifying between different members of the FTSE, I mean diversifying between things which are just completely different intuitively and constantly.
Cool. Well, listen, let's get some more ideas from you folks out there as well, whether it's for income, maybe that's not possible, or whether it's for just preserving your capital. Any great ideas from you in the hall as to where you're getting stable returns? Could you just give us some ideas? Do you think it's possible, first of all? Have you got some things that you're looking towards keeping you safe overnight? Put your hands up if you have a commitment to finding stable returns, or maybe you're in Mark's camp and you just don't think stable returns are possible. You think, well, at some point I'm going to have to ban you from talking, of course. But given you're the only person to put your hand up, you will be here. Go ahead.
About stable return, I differentiate. Is it as a company or is it individual? For me, for example, I run a business, and if I want to secure a stable return, I'm trying to probably bring as many as possible different pools of income into business that I can reach my bottom line per month, per quarter, per year. I don't think you can generate stable return from one client for a very long period of time purely because they may not need your service. You can just finish probably working on a project for them. Maybe they would be, if they are growing, you might be too small for them, or vice versa. If they are going down, you might be too big for them, they cannot afford you. So I think it's pretty much, for me, stable return comes as you keep optimal number of income streams in your business, and kind of you are very focused on getting that bottom line. Above is a bonus.
Cool. Anybody else with sort of thoughts on that? Yes, that's really that.
Yeah, I think there's disintermediation risk premium. Direct lending is one of them. P2B is one branch of it. So that would be a stable form of income. Is it safe? Well, I think safe income, safe returns are dated up, being made off. So there's nothing like a stable, safe return.
Right. Oh, okay. Actually, the gentleman back there. Forgotten your name, but you spoke to us earlier on. Well, that's a tricky subject, this one, isn't it? Absolutely. It's the one.
Actually, stable return, I would agree with Jill when he said that we cannot talk about return if we don't talk about the risk. And for example, for us, if you can accept the risk of having your money in the Lebanese banks, you can have a stable return of 5 to 6% if you want. But if you can assume the risk, you can have it. But if you cannot deal with the risk, for example, regaining the risk, you cannot have a stable return. This is our idea from stable return and risk. This is
well, listen, we've got more topics to cover. We've got 15 minutes left of this discussion. But one of those we've touched on already a little bit there, but we're asked to consider how much expertise should a family office buy in, how much should a family office do for itself. I'm going to start off here with Giles. We talked about the due diligence, we've talked about individual expertise that you might have innately in your team anyway. How do you make the choices to go to in-house or outsource?
I think as a matter of principle, we're completely agnostic on whether we do something ourselves or whether we do it with somebody else. It's just a question of what gives you the most attractive risk-adjusted return for the investor. We believe, effectively, we invest in things that we feel that we can understand, and if it's something where the execution or the due diligence or the background to a particular area requires particular expertise, then we change from being analysts of that space into being selectors of people. And we've spent a lot more time on our industry relationships and banking relationships, broking relationships, hedge fund relationships, etc., where we have an enormous universe of people who are very much more talented in any given area than we are. And our view is that our add there is our ability to select them against all other possible options. And secondly, our ability to look at a space in the context of all the other possibilities that there are and say whether it's good or not.
Peter, I think you overlap with Giles there by saying, when you need specific expertise going in perhaps to a new field, that's where you look at expertise at the right price.
I completely agree.
And Mark, stay on your toes, alter that.
So for the really exciting part of our portfolio, which excites us and our clients, is the 20% in direct and private equity, and for that we absolutely outsource that expertise. For the 80%, which is our knitting, this is where I I don't have any friends in the manager business, because I don't think that managers of listed securities really, that's not the most important decision. The most important decision is to get the beta right, and then my preference is always to go for liquidity, cheapness and trackers. And I only use a manager when they are accessing a speciality part of the market that I can't do in any other way through a basket of stocks and so on. And then we are also extremely active in the management of those managers, because we realise there are environments where managers can do well, and there are managers where environments cannot do well, even though managers think they can do well in all environments. And so we take money away and we give it back when we think it suits what they do. We don't keep managers for the whole of the investment cycle. Some managers don't like that approach. They want us to give them the money and to keep it, and we don't give them any money at all.
Cool. Let's hear from you. I mean, especially if you're maybe in a single family office, not too many clients, just yourselves maybe. How complicated is the process of buying in expertise? Any thoughts here from you as to whether it is a really complicated process trying to find out where you can get good advice, where you can get external management, or if you're uncertain about going into a new field, do you just not do it? Any thoughts on that? Could I have anybody who's waving a hand and saying what they do, how they choose to be in-house, or whether they choose to be outsourcing? Oh, she starts people off, so I'm going to yes, please. Go on.
To answer shortly, I think it's about network. If you are a single family office, or a person who needs to buy a lot of expertise outside, it's all about building quality, relevant network.
Does it feel lonely sometimes, folks? I use that word in my opening speech there. These networks, are you growing them? Are they natural? Are they instinctive? Or do you have to go work at them? It's good to know. Mark, because we were sort of rather a baby network, but that's important.
It's important. So the WIG was born out of a desire to share manager research and recognition of the fact that the resources required to research that were substantial, and the payment and the reward is very little. So we didn't want to buy from any provider of manager research, because I don't pay for the marketing budget, and I always ask which ones didn't show me, and they tend to only show you the tried and tested, which is not necessarily the best. So we sought to share information with like-minded, aligned, single and multi-family offices that were strategically placed around the world, because they tend to have a natural home bias. So the UK offices tend to be the most global in outlook. And it's no secret who the members are, there's all of them on the website, but we're not commercial, we're not profit driven, we are purely there for informal sharing information and meeting twice a year. And it's proven to be extremely helpful in the sharing of research, and also for doing co-investment opportunities.
Well, perhaps, when choosing a manager, possibly very simply the two things to look at is whether the setup is, the operations are stable, if there is any weakness that may lead to a tail event, fraud or just dysfunctionality. The other issue is whether or not you can extrapolate a statistical analysis. So you can do a lot of filling in tables and checking performance going past. The issue is it likely to continue or not? And in order to judge that, we find it helpful that whoever makes that judgment probably has done something similar to what the manager we are looking at is doing, and also judge the human being. And that soft issue is actually quite important.
Well, listen, we've got a bit of a tease in the programme. We've been asked this question. By investing in a decreasing yield environment, are we sowing the seeds for the next distressed debt cycle? That's a bit naughty, isn't it? We've got about 8 minutes left, so I think we're going to get into that one, really. We'll start with Mark.
Well,
short answer is yes.
Yeah, that's a very complicated question. So I'm just going to no. So I'm going to say, firstly, it's inevitable that we will have another distress cycle, because that's the nature of capitalist economics. So that is inevitable. I don't think, though, that we are necessarily sowing the seeds of the next distress bubble. We are definitely sowing seeds for future problems of those who are forced institutionally, or for whatever reason, to buy government bonds at these current ridiculously low levels, because, as Giles said, there will be a day of reckoning and they will make losses, and they'll be surprised to the extent of those losses. But I don't think the fact that and there may be a misallocation of resources caused by this very low interest rate environment, which is why there's a need for macroprudential supervision is absolutely essential at this stage, and sensible organisations by the banks and so on. And I'm very happy to see this intermediation of lending from the banks to family offices, because I think the quality of those decisions are infinitely superior to those of the banks. So I think, I can see it's a loaded question, so the answer is yes, but not necessarily just because we have a low interest rate environment today.
PG, you think the regulators will save us?
I think that if there's going to be a bubble, and I actually think there is going to be a bubble, especially in our continent going forward, I don't think the banks will create it. I think the banks are being castrated by the politicians at the moment. They're quite impotent. I think the bubbles will be created by other people's money. The reason I'm saying it is that since part of Europe has difficulties in adapting their policies, their reforms, to the new world where people live longer, where things are made in other countries cheaper and better than we do, where capital and individuals move from a dysfunctional country to a more functional country, if the policy, if the speed of reforms is slow, then the European Central Bank certainly has to keep rates and currency low. And in that environment, it is obvious that people will borrow to buy assets. And hence, prices are going to rise.
I think Howard Davis is around about still, so we'll just see if he's still walking freely and not castrated. We can talk to him and see him about that later. But Charles, some thoughts on that, just.
I think you have to differentiate between the credit risk and the interest rate risk. And the credit risk on the whole, we're reasonably happy with. I mean, there are certain pockets, if you look at the tight oil lending in the US, where effectively just the capex spend on the wells is so intensive over such a short period, and the production of the well is over such a short period, that you're very exposed to spot price dropping off. And I think that's something people only appreciated rather too late. But generally, credit's okay. Interest rate risk, you're not being paid for. I mean, it's that simple. If you look at from a regulatory perspective, there's this whole problem with credit rates. So sometimes it's the banks being nuts for lending too cheaply, and sometimes it's people's fault for borrowing too much, and so on. If you look at, say, a country like Switzerland, where yields are negative quite a long way out down the curve, intuitively they ought to just be borrowing as much as they can, because it has a negative cost, and yet, you know, we take a regulator to look at that and say, well, maybe that's not such a great idea, because at some point, you know, you've got to generate a return from that perspective. So.
Good. Thank you, gentlemen. Still time for a couple of questions either on that subject. This gentleman here in the gold tie. And also you can return to any of the other subjects we've been covering in this discussion as well. That's very smoothly walking Howard Davis, proving all is well in the virility of our bankers. So go ahead, sir.
Wallace Warmway from Oyster Partners.
We can't hear.
Wallace Warmway from Oyster Partners. I'd like to raise the point from a single-family office perspective, because a lot of what is talked about at conferences like this is from a multi-family office perspective. And multifamily offices can frequently get on the slippery slope of marketing, distribution, and competing head-to-head against private banks and other asset managers. And single-family offices really have a focus on their particular family. And in looking at a single-family office's objectives, whether it's income, legacy, long-term planning, the operating assets of the single-family office, the operating business, can frequently drive the asset allocations. Because there may be one, two, or more big operating businesses that counterbalance what is going on in direct equity and private and public equity and bond portfolios. So my question to the panel is, if you were advising a single-family office that was not interested in going into your multi-family business, is there anything different that you would say about this environment that we're in?
Sure. We'll keep it brief, John, because we're almost at the time of the market.
Yeah, I would go and say within the Wigmore Group we have two substantial single-family offices that we meet twice a year with, so I'm very familiar with that issue. Interestingly enough, both single-family offices have very different objectives. One resulted in a very high level of direct investments and other businesses investments within its portfolio, so it's highly liquid because it has strong income from the main businesses. The other one has, even though it's much larger, has actually a relatively small direct investment and a very substantial portfolio of listed securities. So there is, there's no simple answer to your question.
Okay.
I think, from a similar perspective, there are enough risks out there which are attractive that you don't need to duplicate something you've already got. I think we're very mindful of our clients with operating businesses that not only is that an attractive risk return that they know more about than any investment manager knows about the stocks that they cover, but also in terms of the family as a whole, you can't underestimate the value of the identity and the coherence that an operating business gives the family, and is therefore something I think to be encouraged, and to be the master and everything else is the servant. And from that perspective, there's no point in going in and saying, when are you going to sell this thing? You just have to find a selection of interesting risks and make sure that the investor is comfortable with them, and they're probably outside the public markets.
Any thoughts, Peter?
Obviously, there is a mandate to follow from the principals, and the staffing of the single family office reflects the core interests and core competencies needed to serve that. What is on the periphery is then outsourced.
Peter Gillenberger, Mark Hendricks, and Giles White, thanks very much indeed for your contributions there.